Leo Trade. This is Don Kaufman. It's April 21st, 2023. We are just seconds after the cash close here on this Friday afternoon. Yeah, once again, the market's finishing massively unchanged. From boring to thrilling. This weekend's update is going to be discussing unlocking the power of options trading in a flat marketplace. Well, flat it is right now, but people, that is not going to last. And there's actually some wonderful setups for some trades throughout the course of this week. So one of the things that I always do is talk about, like, get your trade on. And I got to tell you, I was able to execute into a couple of trades that I haven't been able to do now in years. The skew is phenomenal. We're going to talk about that in quite some detail here. Again, literally years since I've been able to get some of these types of trades on. But first, well, let's recap what is absolutely nothing of a range inside of the S&Ps. And again, it's a complete and total anomaly. We have not hit the upper end or lower edge of an expected move in the SPX now in the last 3 weeks. Let's start with this. Here we are looking at the S&P futures. I've already got a 30-day 1 hour. Listen, I like my 30-day 1 hour. Okay, I like it because I think it exemplifies that that range and includes like overnight trade. Look, everything, and I do mean everything that we've seen since, well, roughly speaking, the beginning of April. Here we are at the beginning of April to right now falls between 4,100 and just shy of 4,200. What is so interesting about this? I mean, literally 100-point range of the market. You're like, oh, whatever, man. I don't care. So the rally is actually faded completely. We're stuck inside of a range right now. But what's so interesting about it is that, you know, we're still doing this in a 16, 17 VIX, closer to 17 VIX. In fact, the VIX, though, only this week really kind of crested under that 18 level. So like volatility overall, and again, I want to show you this on a longer term horizon here. Volatility overall, if you look back over like the last 5 years, it's still high on a relative basis. In fact, I'm going to highlight that so everybody can kind of see it, right? Like we're still in a relatively high volatility range, which if you're trading options, you're like, oh, this is rather beneficial. We're still getting a lot of bang, you know, for the buck that we're selling in terms of selling options premium. Still getting a lot of bang for the buck out there and an almost a 17 VIX, and yet we're not moving, which I gotta be honest, makes me incredibly nervous selling premium in a lower volatility climate. You just, I mean, you know, at this point, when we move, oh, it's gonna hurt. It is gonna hurt. And I really do mean that. When I mean by hurt, you're gonna have this explosion up, the explosion down. And this is a time and place that let's just cut through all of the garbage out there. Look, there's a huge amount of negative news that's come out. All right. The marketplace just stared at it and just laughed and kept right on moving. I mean, even like Tesla, let's not even talk about like, you know, PPIs or CPIs or any of the reports that have actually come out. Just talk about Tesla for a second. It's down 10%. What did it do the S&Ps yesterday? Absolutely nothing. It threatened to pull them lower. Okay. It was a threatening gesture. I mean, literally, if you look at the SPX, the mother of all products, okay, if you look at the SPX and I zoom in to this week's expected move, check this out. The central line that I'm kind of coloring in right now, that is where the week started. Where are we right now? Massively unchanged. How many times can I possibly say that in a week? Well, a lot, because I like it. What did the QQQ do throughout the course of this week? Taking a look at the NASDAQ, the most astounding thing is the NASDAQ. Let's bring up auto expected moves there. It was down mildly because of Tesla. But the NASDAQ is even more surreal. Take a look at the NASDAQ futures, the 30-day 1 hour. 30-day 1 hour. And again, this is where, like, I almost have to pause, if you will, for a moment of silence for the NASDAQ, because this is the flattest I've seen it since all the way back. I have to go back to 2017 to actually see activity like this. And what I mean by, look, 5-year chart doesn't even do it anymore, right? Max chart possible. No, I've got to open up more significant time frames in here. I'll go to a weekly chart and open up the last 10 years. But the last time that we saw activity like this, this flat was like summer of 17. Oh, I remember it well. No, but it is that flat. Time of death. Well, all of April. Let's get down to it though. One of the things that's really bothersome in this marketplace, okay, isn't the fact that we're stuck at a range. It is what it is. Like, look, I've been in situations like this that have lasted months. Like, again, the entire summer of like 2017, we're stuck in a range. What is surreal about this particular range, though, is that volatility is still relatively high. We have tons of little, like, I guess what we term tape bombs. In fact, this next week of trade, for those of you that are kind of in the know, I say the next week of trade, literally looking out to this next week, you're going to get all kinds of tape bombs. What I call a tape bomb, for instance, like today, PPI came out, durable goods is going to come out this next week. You got some GDP flashes actually coming out, monthly GDP, Chicago PMI. Even we're starting to pay attention now to jobless claims a bit more, pending home sales. Like every little data point is what I term a tape bomb. Why? Because it literally hits the tape and boom, S&Ps move on sometimes the most non-influential data out there. You're also going to hear, a little bit from Fed again, but Fed is about to go into their quiet period, so be quiet. Okay. Advanced decline line out there has been like a 50-50, but again, spinning it back around, it's not so much the flatness in the S&Ps that's astounding. It's actually, well, the S&P 500 is basically 5 stocks right now. And to me, this is the most, I think, critical area to understand. And I'm actually going to start kind of, like maybe a little bit of a top-down approach here. Look at Microsoft on a year-to-date basis. Microsoft's basically up about 20%. Obviously, Apple's up about 32%. Okay, then we're going to jump over to Google. Google's basically up close to 20%. I know it's 18%. Meta flying up 70%. Tesla, okay, up what? 52%. And that's even after getting decimated this week. Last but not least, NVIDIA. Okay, NVIDIA is up almost 90% of the top performers, or the top performer inside of the S&P 500. People, that's it. You got nothing else in the S&Ps that is that's worth even discussing in terms of market cap. Start looking around the S&Ps again on the year-to-date basis, and I'm serious. Really look around the S&P, and you're like, okay, let's bring up some Amazon. Amazon actually does have a bid, but it's nominal in comparison to some of the other market caps and some of the returns in there. So Amazon does count. I will give you that. We start looking at like the energy sector. The entire energy sector is basically flat on a year-to-date basis. You look at the financials, they had a little crisis already, but they're only down 3%. Start looking at individual stocks like Caterpillar's down like 8%. Boeing is no 5%. Oh, look, it's actually positive on the year. Okay, where else do you want to go? You want to go to stuff like Intel up 13% and Starbucks over here up 7%. Look, the point that I'm trying to make, and I'll even come out of the S&P 500 to stuff like Chinese stocks like Baba, which is down 3%. As you start to really dig around, okay, you have 5-6 performers in the entire S&P 500. The rest is for nothing. There's this incredible right now concentration into the S&Ps, which to me is actually one of the reasons that I think that volatility should remain. Even if the S&Ps are flat, volatility should remain higher right now. Okay, why? Concentration. Tech has actually camouflaged. It really is camouflaging some of the weakness of the broader marketplace. So when you're looking at VIX and you're thinking like, oh, the VIX is really, low. First of all, I disagree with you. Okay. The VIX has come down substantially. That's, you can't argue that. Obviously, it's come down. It's come down a lot. Okay. But it's still high relative to the fact that the last 3 weeks, we haven't moved. I mean, literally in a 100-point range. Okay. So why is the VIX remaining where it is? Because I think the marketplace actually sees exactly what we're talking about here, that the concentration of returns, okay, the returns in the S&P on a year-to-date basis, speaking of the S&P on a year-to-date basis, let's go ahead and bring it up. So the S&Ps have returned about 8% on a year-to-date basis, okay, almost all of the return, that return inside of the S&Ps is based on 5 to 6 tech stocks, and it's really camouflaging. So in effect, diversification is completely dead. The QQQ, forget it. The QQQ is owned right now by a handful of stocks. Qs are up almost 20% on a year-to-date basis, right? Now think about, why am I even covering this? Think about the dangers we're actually going to be driving into next week. Next week, obviously, some of the bigger of the big are going to have earnings. I'm just bringing up like a quick earnings scan over here, but look, okay, of the stocks that I just mentioned, Google, okay, all right, yeah, you got earnings next week. What else you got? Well, you already heard from the likes of Tesla. Okay, NVIDIA, you're not going to hear from for a long time. NVIDIA is actually out of the same phase, out of the same cycle. Obviously, we heard from Tesla, okay, down about 10%, but didn't have a dramatic impact. Okay, you're going to hear from, of course, Microsoft. I'm just making a quick point over here. I don't want to go through every single stock that has earnings. The point is a very simple one, okay? What's it going to take to snap the back of this marketplace? Could it be like Google, Microsoft, okay, and or Meta coming out, with misses? It's not going to take much. I mean, in theory, it could be literally like one underlying, like Microsoft comes out with a, look, it's got a $2.1 trillion market cap. If that sold off by 10%, you're going to slaughter the S&Ps on a given day. So, lo and behold, diversification is dead. You start to look at stocks like Apple. Okay. By the way, Apple is not going to have earnings this next week. It's the week after that. But look, stocks like Apple that again, they own the S&P at this point, and Apple is now up to a $2.6 trillion market cap. When I say it owns the S&P, again, I don't want to concern anybody to the point of like sheer panic, but you have no diversification right now inside of the S&P 500. And moreover, if your portfolio at this point, if you own the spiders, sure, you're up that 8-9%. But if you actually are well diversified, you're basically flat on the year. It's really a unique time in there. All right, so let me actually switch gears completely because I wanted to discuss that. And I also wanted to discuss, I guess, one last aspect over here in this, okay? Look, we're coming up to this 42.11 and we're coming down, or we're coming down to 41.06. And there's no in between, and we're going to reassess after that. These are the levels that matter right now. And the next move in this marketplace is completely and utterly binary. That basically means is this is going to be a coin flip higher or lower at this point. And even though you think, wow, there's been tremendous bad news, look, bad can actually be construed as good. The jobless claims is a 17-month high. It might be good for the marketplace because maybe the Fed then won't raise interest rates so much. So again, we are in a very, very funky period where we're a coin flip away of exploding higher or lower. And it's okay. You can actually trade with that notion. In fact, we're going to talk about that right now. So lower vol, it's not so bad. It's not so bad because skew has really picked up. The skew is with you. For those of you that have absolutely no idea what skew is, right? And I always like to reiterate that there are, there's people that are going to tune in, they're going to hear the term skew, and they're like, I have no idea what he's talking about. Out of the money puts versus out of the money calls, implied volatility. So when I talk about skew, what I'm really referencing in skew, I'm actually going to jump over to the spiders for a second. Gotta love those area charts, right? I'm going to jump over to the spiders for a second. I'm going to come just about 28 days out. And I'm going to change volume here to what we term implied volatility. And I'm going to open up, let's make this easy, 40 strikes. Okay, 40 strikes. There's just 28 days out. And again, all I want to show you in skew is this. Okay, right? We're going to highlight it. There's implied volatility of the puts. See these out of the money puts? They're not that far out of the money, but the puts are up to about an 18 vol. And you look at implied volatility of the calls, remember? Okay, that side's calls, this side's puts. And you look at the implied volatility of those calls. So the puts that I'm showing you are trading at an 18 vol. The calls that I'm showing you are trading for a 12 vol. There's this huge gaping differential between put implied volatility and call implied volatility. Right now, that is what we term skew. That actually opens up quite a number of interesting trades. In fact, we're going to show you that right now. Let's jump to it. Let's talk about get your trade on this week's profits and losses. So this week, rather than just talk about profits and losses, I took off some trades. I took off a lot of trades, I should say, and I took them off profitably. But at the exact same time as I took these trades off profitably, and I'm just going to run through them really quick. To me, what's kind of cool about this week is I put a lot of stuff on. Okay. And with the skew being so big, I was able to take these incredibly like valid shots in the marketplace without having to absorb, okay, critical amounts of risk. So, all right, first of all, what did I take off? I covered ES calls, okay, and MES calls. So for those of you that have no idea what an ES is the options and futures. When I say I covered, okay, I bought them back. So you can see I covered here on 420 and 420. I covered some 45.50 calls. I covered some 46.50 calls. Then over in the MES, and I can cruise over here and show you all the activity. By the way, again, I trade in a whole lot of accounts these days. So some of the activity this week in the MES, I actually covered a 3 lot of the 4,500 calls. I also covered a 1 lot of the 4650 calls. So it's a party, people. Okay. In addition to it, what else did I do? So I covered the ES and MES calls. Then I closed a Tesla Catapult spread for a massive return. So for those of you that don't know, Catapult is basically a strategy where I go out, and I'll give you an example here. I went out and bought a Tesla put spread, which means I was bearish, okay? And to finance the cost of that put spread, I financed 100% of the cost of the put spread in Tesla by selling, okay, an MES, which is a micro S&P put. So I covered the put weeks ago profitably, and I still had this Tesla spread left over. Guess what? Tesla earnings came out. It's a home run. It was a $5 wide spread, and that $5 wide spread was actually closed for $4, which is, when I talk about like a huge return, what is the return? I paid nothing for the spread and actually closed it for $4. Every one contract's worth 400. You realize you can do that a whole lot of times. Okay, so it was a home run this week for the Tesla spread. It was a home run and actually closing some inventory. So what else did I do? All right, opened up the mighty Christmas tree spread. For those of you that have no idea, again, what a Christmas tree spread is, let me show you the Christmas tree spread. It's a 1 by 3 by 4 by 5. This is a trade, people, that is all about skew. Okay, if the marketplace is anywhere, and I want to be very clear about this, but if the marketplace is anywhere above 330, that's the spider above 330, which is almost, what's like 20% lower, but anywhere above 330, we're profitable. We're profitable to the tune of a minimum of about $1,000. However, there's a little bit of a kicker in here. If the marketplace comes screaming down, I might be able to make as much as about $5,000. So the Christmas tree spread is a trade that is designed in and around skew. And skew right now is exactly what we have. But if you look at this trade, of course, people are looking at it and they're going, all right, so if we go anywhere higher, I make $1,000. If we go lower, okay, I make $1,000. But if we go lower and you start getting around 360, 350, 350 is the absolute pivotal spot, I can make as much as $5,000. Then I know what you're doing. You're looking right now, right here, and you're like, but if we break lower, I could get crushed. If the market crashes, you're dead. Yeah, think again, because I also opened a VIX volatility spread. Want to know what a VIX volatility spread is? Oh yeah, the quintessential VIX volatility spread. If volatility explodes, okay, I make money. What did I pay for the trade? I didn't. The VIX volatility spread is actually put on for a 5-cent credit. So I put the VIX vol spread on for a 5-cent credit. Can I lose money on the VIX vol spread? I can. I can absolutely lose money. But if I lose money on the VIX volatility spread, inherently I make money, of course, in the Christmas tree spread. Oh yeah, they're designed to work together. But here's the bottom line. If VIX is anywhere above 18, if the VIX is anywhere above 18, I'm gold, Jerry, I'm gold, because 18 is actually the short put in here. So if the VIX is between 18, okay, and basically, what's the short strike? Or sorry, the long strike is 26. If the VIX is between 18, 26, I keep 5 cents. If the VIX goes above 26, I make money. If the VIX goes below 18, I'll lose money here, but I'll make money back in the Christmas tree spread. So those two trades are what we often term a little congruent. All right. On top of it, because of also heavy skew, I was able to actually open up some S&P options on futures in here. And what I basically did is when I was able to go out and sell some premium, my hedges were dirt cheap because the skew is so heavy right now. So for those of you that understand Ultima, you're thinking to yourself, oh man, the volatility is crushed. I'm not going to be able to do anything. The exact opposite is true. The volatility is crushed, but the skew really picked up. And if you look at the 35-day options, most of the time when I'm out there and I'm buying hedges, Okay. Most of the time, my hedges can cost, I buy like $100 wide hedges because I get a little serious about my trading, but I'll buy like $100 wide hedge inside of the S&P options and futures. Hedges now are going for 15, 15, 25. But the strangle that I'm selling, because skew is so big, the strangle that I'm selling is actually still selling for, between $30 and $31. So it's been some strong trade throughout the course of this week. And I got to tell you, I am positioned like bring it on. Just bring it on. I don't care if we explode higher, explode lower with those trades. The premium sales, okay, are not going to be affected over here. The VIX volatility spread, so be it. If the VIX vol spread goes against me, the mighty Christmas tree spread will work out. If the Christmas tree spread, works, the market sells off, the VIX volatility spread may work as well. I mean, I am just situated beautifully right now for a little punch of volatility. And I got to tell you, I don't care if the marketplace explodes higher and then crumbles. The one thing I will tell you, though, is this marketplace, look, it's boring to thrilling, and that's exactly what's going to happen. It's going to turn into Mr. Toad's Wild Ride again in the near future. All right, last but definitely not least, we like to talk about the SPX, which did absolutely nothing. So here we have a little bit of an anomaly. It happens, okay? It happens, but incredibly, incredibly infrequently, that we have not hit the upper and or lower edge of an expected move in 3 consecutive weeks. All right, so I started actually keeping track all the way back in 2017. I can find instances, okay, but we're talking like it missed the expected move by like a point or two. So this is really, really an anomaly in here that 3 weeks we don't hit the upper or lower edge of the expected move, and everybody's pointing fingers. It's the zero DTE options. It's this, it's that. Look, it's just a compression of volatility. It's compression of volatility. Meanwhile, skew is picking up. Look, don't get off your game. Seriously, do not get off your game, because next week, okay, and I'm looking at the expected move right now with you. Next week, we're still expecting about a $61 and almost 70-cent expected move. So for the most part, even though this week nothing happened throughout the course of this week, the expected move is actually higher next week because there's decent amount of earnings, right? There's also going to be a number of tape bombs and data drops throughout the course of the week. So game face on. A 60-point move. Look, what's going to happen in this marketplace is we're going to go from compression of volatility to absolutely erupting into it. So this is where you just do not want to get caught flat-footed. One bad trade on an intraday basis can rip people apart in a marketplace like this, because what we're going to probably see is a marketplace that doesn't just lull us, okay, into a false sense of security. We're already lulled into the false sense of security. We're going to look at a marketplace that's likely to just do kind of what I call a snap back into some heavy vol. Could happen overnight, could happen during trading day, could happen on any one of the data points or earnings that are coming out this next week. But again, keep your helmet on. Volatility is far from dead. From boring to thrilling, you got to learn to really unlock the power of options in these flat markets. Thanks everybody for joining us here at Theo Trade. Have a wonderful weekend. Bye-bye.